Yeah, I think as investors, we're always dealing with change and observing change, whether it's social change, changes in patterns of consumption, the way people are behaving, economic change, new regimes, technological change probably at the front of everyone's mind right now with the development of AI. But more often than not, it's about how we respond to that change as investors, how we react to it, what context we view it in. Is it a continuation of an existing theme? And that's the way that we can find businesses that are going to survive and thrive and earn higher profits and improving returns on capital over the long term. I think the technology of AI definitely has the long-term potential to be revolutionary, and revolutionary in the similar way that the internet was revolutionary for the media industry, and it transformed advertising as everyone moved online and used the infrastructure that was put in the ground by the telecom companies in the late 90s and early 2000s to change the way that we consume TV or social media and all the advertising that went online. For AI, we're at the infrastructure phase. We're building the new network the same way that we built that new network in the late 90s. And this time it's the companies who benefited from the telecoms expenditure who are doing that spending and putting that capital into the ground with the new AI data centres. So the stage we're at today really for the cash flow and profitability within AI is in the infrastructure providers, the companies who do the hardware, the kit to run the network. So NVIDIA with their chips that make those servers so powerful to run those large language models, they're benefiting right now with that expenditure happening and the cash flow and profitability accruing to them. Longer term, it's going to be about the applications. What's the application that's going to revolutionise the next industry and do the same to the advertising industry that the internet did in the last decade? That remains to be seen and actually takes time for these applications to emerge. Google didn't IPO until 2004. Facebook didn't come along to the public markets until 2010. That's 5 to 10 years after that infrastructure phase that we had with the internet in the late 90s. So we're at the infrastructure phase for AI, and it's still quite early to tell what those applications are and what the return structure will be in terms of profitability for the companies that are spending on the infrastructure today. And that's the part that we're going to find out over the next few years. So definitely an opportunity for revolutionary technology, but we need to be careful for where the profitability is going to be. Yeah, we've had a period in markets where the top stocks, the top half a dozen stocks or so, have accounted for a massive part of the return in the overall market. We think that's unlikely to continue forever. That kind of goes without saying. It's such a broad listing of companies, more than 5,000 stocks listed in the global share market. So it's unlikely that this is going to keep going on and on and on. But the direction of profitability and return on capital will really determine what the outcome and the timing of that. And we've certainly seen those big companies have the best improvements in cash flow, the best improvements in return on capital, and that's what's driven their returns relative to the rest of the market over the last couple of years. That likely will slow down, and when we look at periods in history where we've seen this before, and they're actually quite regular, once every 5 to 10 years we've seen this in markets all the way back to the 1950s. It's not always a bad thing for the equity market in the following year. And that's something to bear in mind. But the one thing we do need to think about is the quality and the valuation of the company that you're paying, that you're investing in. And we think that's not going to be any different going forward. So yeah, the market should broaden out, but investors should make sure that they're investing in high quality, stable, compounding businesses with the right valuation at this point in the market cycle. Yeah, I think with the infrastructure rollout for AI and what's going on there with energy transition as well, the opportunities in other sectors of the market are becoming quite interesting and quite a little bit broader maybe than we've seen over the last couple of years. And we like areas in industrials in particular. So the electric grid has been underinvested, particularly in Western markets in the US and Europe. We haven't spent as much capital on that grid grid infrastructure as we maybe should have. And now with electrification, the more information that moves around, the more we go digital, the more we need electricity, and the more demands we're placing on the grid. And when you add in the fact that we've got new sources of generating capacity, whether it's wind or solar, nuclear expansion of generating capacity going in, we need to invest in the grid to step that voltage up and down and move that electricity out to the point of consumption. So we're investing in some of the businesses that sell the equipment to help with that expenditure, and we think they've got great prospects over the next 5 years or so. One thing after these periods of market concentration that's been quite interesting over the years when you look back at history is that defensive, high quality, stable companies start to look really interesting. So by that we mean businesses in the healthcare sector, for example, or the consumer staples sector, where these companies have really been under pressure over the last few years. And in the last 18 months especially, when interest rates went up so sharply in that period, why would you buy a consumer staple company with a dividend yield of 3% when you could find a yield of nearly 5% in a US Treasury? So a lot of people came out of these companies. They had cost pressures, they had to put prices up because of inflation, and consumers got a little bit fed up with those tiny chocolate bars where you don't feel you're getting value. So they had some earnings pressure. As costs come down and that disinflation goes through the wider system, we should see some of the pressure on those businesses come off, and we'll see those earnings start to recover. And above all, because the bond yields are beginning to come down, we think that's very supportive for the valuation of these high quality defensive companies. So the economic weather forecast just got a little bit worse. The good news is that the price of an umbrella is still quite reasonable, so we've been adding a few of those into the portfolio. Yeah, I think we've got at the macroeconomic level, we're stock pickers, but we do have to observe what the macroeconomic environment's going to be, and we've got quite a lot going on. I think the obvious thing is a slowdown in the US economy, and we're now moving into an interest rate cutting environment, and the Fed have flagged that fairly clearly. We've seen other economies like here in New Zealand already on that path of cutting rates and responding to a slower economic environment. But interestingly, and a little bit different to the last decade or more, where policy has been very coordinated. You've got that situation in Japan where they were lagging behind. They were keeping their rates low to bring that economy, out of that long-term kind of deflationary environment that they've had. So they were keeping rates lower for longer, and they're only now beginning to increase. So we've got this slightly disjointed or a sort of counter move in policy between some of the biggest economies in the world, and that seems to be having a bit of an effect on currency markets. We might see a weaker dollar now, having seen a stronger dollar for almost the last decade, and with the increasing rates in Japan, maybe a stronger yen. So Japan might have to work harder to achieve the improvements in profitability and return on capital that they've made so far, and that's going to test their commitment to that improvement in governance and the improvement in corporate activity that they've been talking about for the last few years. Yeah, I think as we move into a rate cutting environment, investors need to be mindful of the reason that we're cutting rates, and that's some of the risks that they probably need to look out for. The reason we're cutting rates is that the economy is slowing, and that's going to pressure the profits and cash flow in lots of sectors across the market. Also, we've had this period of narrow leadership in the market, and the big stocks performing brilliantly and with the best and biggest returns on capital improvements in cash flow. And that might be slowing down just for the practicalities of deploying the infrastructure that's being built for these technology industries and new areas like AI. It takes time to build data centers and to deploy that capital into the ground. So maybe the earnings cycle might slow down to some extent. So if we've got slowing earnings, we've got a slowing economy, we want to make sure that we're investing in really high quality, stable, compounding, often defensive companies, where right now the valuations are quite reasonable. So I guess the biggest risk is around that slowdown that we're seeing. Don't get too excited about the rate cuts. It takes time for them to have an impact, and then we'll see that flow through into the economy probably next year, at which point markets start to look a lot better.